Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's Head of U.S. Macro Strategy. It's Tuesday, November 29th, 2022. Welcome back to the podcast, George.
Hi, John. Good to be back.
Always good to have you. And it's been a couple weeks. And actually, those last couple weeks in the markets have been surprisingly, tame, especially in comparison to the year we've had up to this point. It seems like the market is stuck, post that sort of epic rally across both risk-free assets and risk assets after the lower than expected October CPI print. For example, the 10-year after collapsing under 4% is traded in really only like a 20 basis point range. And the same, I'd argue, is true for stocks. They certainly rallied off the lows, but they have not been able to break above the 200-day moving average, as example. So I guess the question, and that's sort of, I got to be honest, that price action is really confused me. Treasury yields where they are here, as example, don't make a ton of sense to me. Equity valuations, pretty healthy, also doesn't make a lot of sense to me. So for me, for the benefit of the listeners, help me understand what's going on.
Yeah, I think like we've kind of alluded to this in some of the podcasts leading up till today's. We're recording one day before a month end here in November. There was a decent gap after the CPI release in the early part of November, and really up until now, we had the minutes last week, which on balance, we're still suggesting a similar story that we've heard all along, which has been echoed recently in the last week from the Fed speakers. But it could have been more hawkish, I guess. And basically, we haven't really gotten really new information that we haven't heard from before, and so I think that this is kind of resulting in a market that's getting less of a conviction on either direction, to be honest. And vols have been coming down, and the ranges have been compressing, and so that November 15th through the end of this month has really resulted in a kind of vol compression, choppy trading, no less, but still nothing really clearly defined on what the next clear move is. So I think it's purely just a function of less headline risks to go through, although we've had some external risks that have come through. Given some of the developments out of both China and Europe, but nothing yet that's been enough to change the macro thesis on like where we're heading for the economy and globally, not just the U.S. So I think that it's just this kind of fatigue, exhaustion after again a very really rough year that will take this 2-week lull that's been given to us during November to really consolidate before we make the next moves. And I think really that's really the key point here is like what happens next is much more important than what got us to this point of like what almost feels like complacency, but maybe it's just buyer seller exhaustion, tough year, this fatigue sets in, you get no new stimuli to change your views, and you just compress into a much more narrower defined range.
Yeah, that makes a lot of sense, especially, there's certainly been a huge move. So some consolidation, seems reasonable. You started, talking about, about that next move. Let's go into that a little bit more in detail. Not to put words in your mouth, but it certainly seems like you're indicating that these sleepy trading sessions are not going to last forever. I think I've heard you separately say that this year will likely go out with a bang versus a whimper, given everything that has transpired up to this point, which I'm sympathetic to that argument. So why don't you take us through what you expect as we head into the last month of the year?
Sure. So we still expect one last major vol window, which really is upon us, the early to mid-December period where there's a lot of key event risks that we have to get through before we close out the year. Starting first and foremost with we still have, let me take a step back here and discuss that again. We're recording the day before the end of the quarter, or end of the month for November 30th, and that's also the day where Chair Powell is scheduled to speak at the Brookings Institute to also give an update on his views. It's quite possible that a lot of the stuff that we're discussing might change just in tomorrow's update from Chair Powell if he continues to be his hawkish self, and it might actually kind of steal some of the thunder for the Fed meeting at the middle of December if he clearly comes out and is hawkish and really pushes back on they're not done yet, that they just don't know, given the uncertainty around the inflation outlook, that it's better to be safe than sorry and over tighten versus trying to stop short. And of course, if you were to further compound that by suggesting that we're perplexed why risk market stocks have been rallying and credit spreads have been tightening, meanwhile we're trying to tighten monetary conditions, drain liquidity, but yet markets are pretty buoyant, like something's not right here. If he mentions anything basically in relation to financial conditions, then that could just kind of tip things off and start off a pretty volatile period for the first 10 to 15 days in December, as we kind of digest all these other event risks that are going to happen. So tomorrow, the 30th, when people are going to be listening to this, will be a super crucial day for starting off the last month of the year, which has been, again, a really tough year. And so, December itself has a number of things to get through. We have NFP at the end of the week. We have a number of global central banks that are going to be meeting before the Fed. And, our research and strategy work has found that, these other central bank meetings actually are bigger market movers at times than the Fed's own meetings. And so we have to get through these central banks, meetings and how they might impact global rates and then therefore impact U.S. rates. We have, the OPEC meeting, the Russian oil price cap discussion on the energy front, which could also lead to some volatility on the energy side. And then we have CPI actually being released before the Fed, a day before the Fed, which is something we haven't seen in quite some time, which, the last few CPI prints have been after the Fed, and we haven't had a chance to see how the Fed reacts after the CPI print. And so the markets would always get super excited whenever inflation is going down because, the Fed meeting just took place. And so maybe the Fed's going to change their view. This is the opposite. Now we're going to get the CPI print before the Fed meeting. So let's say it is on the weaker side, but Chair Powell still dismisses it. That will just be like proof positive that they're clearly trying to get to much higher levels of rates as well as keep them there. So I feel like this is going to be, we've gone through this consolidation period. We've kind of seen the vol compression period. It's helped all asset class kind of weather this period. But again, let's remind everybody, this has been a year where there's been trillions of dollars of losses in multiple asset classes. We haven't seen, or there hasn't been real proof of actual, kind of loss taking exercises by investors. It does feel like people are kind of holding in here. If December were to get more volatile, we can look back to December 2018, which was a prime example of when you have less liquidity and markets kind of get a little bit volatile, that you can have big moves at the end of the year. So I'm still concerned that this tomorrow might kick it off with Chair Powell, and then we get this 9 to 10 day period of volatility into the Fed meeting, and at that point maybe they might have seen enough, and markets might actually adjust lower, and then the Fed's probably happy about that if that's truly their intention on getting financial conditions to tighten. Then maybe after the Fed meeting, we kind of just go sideways from there. But this idea that what we've seen so far will persist and that we're not going to have a move in either direction, that doesn't sit well with me. So I think, we're at a really critical inflection point in the short run. I don't think it negates the medium-term, long-term view that I have that, yes, I think rates should still go higher from here and that the Fed is not done yet and that risk assets still have to go a little bit lower from here into the beginning of next year as we get proof that we truly are heading into a recession.
All right. So hearing it from you, so you do not expect this sort of lack of volatility to continue. You expect things to get a little messy into year end, and that makes sense to me. There's a lot of moving parts here, and a lot of things can go quote unquote wrong, particularly into a finicky period like year end. And you still hold on to the view that rates are likely to still go higher, and risk assets likely to go lower from here. And for more detail, I definitely encourage our listeners to check out George's upcoming November Macro to Markets Monthly. And if you are not receiving George's strategy reports, please do get in contact with them. Great stuff as always. Thanks, George.
Thanks, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any information. Check back soon for more insights from the Global Markets Research Team.